Let's talk about the metals, because that's been a huge story today, too. Watching the LME actually stop trading for nickel as it skyrocketed 250% over the course of 2 days. I mean, that's unbelievable. They're now talking about suspending the actual physical delivery of the contract that was due March 9th. What the heck happened, and what does this mean for the economy?
Well, I want to emphasize that, there is a bullish story to nickel. Remember, it's an EV, it's a green metal. It goes into the battery. So it's part of that green EV story. So strong demand, no supply. And it was, you can see on that picture, it was in a normal bullish upward trajectory like many of the other commodities until the last several days. So what happened over the last several days? Liquidity in these markets are collapsing. And I want to repeat, collapsing across oil, gas, metals, agriculture. Part of that's the higher volatility discourages investors and market participants. And then the liquidity drops off, which makes the volatility get higher. Now, what made this so vicious to the upside, and we're seeing this in other markets like, wheat, European gas, is that you're closing the producer positions. And what happened here is a producer, a big Chinese producer who was short out on the nickel curve, had a margin call. And as they tried to cover those positions and buy it back, it created that huge spike in nickel prices. We've seen it in many of the other commodities over the course of the last 2 to 3 months. Because
but stopping trading was not to protect the short sellers. It was to protect the brokers who would be at risk.
The thing about it is unclear about where's positionings, where's settlements, and things of that nature. So, they absolutely shutting the exchange down was an ability to get a cooling off to figure out where the different positions were. So, I think it underscores just how big of a problem this is becoming. It's not just in nickel. I want to emphasize. By the way, this is what drives big commodity spikes. Even the 2008 spike in oil at the very end, that pop up to 147, was driven by liquidation of producer shorts because they get basically stopped out and get margin calls. So this is pretty typical in commodities. What makes this one different is the magnitude of it.
Shepard Smith here. Thanks for watching CNBC on YouTube.